Welcome to Capital Link's Trending News podcast series. In this podcast series, we discuss with company management on recent news and announcements they have made. I am Nicolas, Bornozis, president of Capital Link, and we have with us today the chairman and CEO of Pyxis Tankers, Mr. Eddie Valentis. Our discussion will highlight Pyxis Tankers' recent business developments and sector outlook. A quick reminder of our disclaimer that our podcasts are provided purely for informational and educational purposes. They do not constitute investment advice or advice of any kind, and Capital Link bears no responsibility for them. And as an additional disclosure, we have the privilege to work with the Pyxis Tankers on investor relations. Now, Pyxis Tankers, to provide a description of the company, trades on NASDAQ under the ticker symbol PXS. The company currently owns a modern fleet of mid-sized eco vessels consisting of 3 product tankers, 1 Kamsarmax bulk carrier, and a controlling interest in a single ship Ultramax dry bulk venture engaged in the seaborne transportation of a broad range of refined petroleum products and dry bulk commodities. The company is positioned to opportunistically expand and maximize its fleet of eco-efficient vessels due to significant capital resources, competitive cost structure, strong customer relationships, and an experienced management team whose interests are aligned with those of shareholders. And now we will start our question. Eddie, thank you for being with us. Let me start with the first question. You now operate in 2 sectors, the product tanker sector and the dry bulk sector, both sectors with positive fundamentals. Can you share with us the main drivers and challenges for each market, for each sector?
Thank you, Nicolas. First of all, thank you for having me again and being supportive of the company. Regarding product tankers, historically, as you know, refined petroleum products and dry bulk commodities have both been moderately correlated to global GDP growth. Earlier this year, IMF slightly revised its 2024 forecast for global growth to 3.1%, with a slight increase next year of 3.2%. In March, IEA slightly adjusted its world oil demand forecasts to increase 1.3% in 2024. The demand for refined petroleum products remains solid due to resilient economic activity globally, which has kept inventories below 5-year averages in many locations. While we are still in the refinery turnaround season in the Northern Hemisphere, crack spreads remain healthy, reflecting solid end market demand. Despite cuts by OPEC+, crude supply has not been materially impacted. However, geopolitical hostilities have dislocated markets and trade patterns. The EU and G7 sanctions from 27 countries against Russia have significantly increased ton-mile activity, therefore reducing tanker supply and further supporting charter rates. More recently, the Israel-Hamas conflict has curtailed transits through the Suez Canal and driven crude prices higher. For example, a tanker sailing at 12 knots from a port in Saudi Arabia around the Cape of Good Hope takes 16 more days to reach a crucial destination port such as Rotterdam. According to Drewry, 4.4 million barrels per day of net new refinery capacity is scheduled to come online by 2028. Most of these additions will be outside the OECD, which should boost ton miles. At the end of February, Drewry estimated the order book for our segment of the MRs to be around 10.7%. Of the worldwide fleet of almost 1,700 MR2s. However, a similar percentage of MRs, approximately 187, were 20 years of age or more. So overall, this year, we expect a fleet of MR to increase of approximately 2%. Now going to the dry bulk. as you know, dry bulk commodities have been significantly tied to the Chinese demand. The IMF has growth in the Chinese economy slowing to approximately 4.6% this year as it recovers from various post-COVID restrictions, real estate market challenges, and restrained consumer spending. In February, Howe Robinson estimated a balanced market for the dry bulk sector in 2024 with net fleet growth of approximately 2% and compared to a demand growth of again 2%. So, however, extreme weather conditions continue to add to the uncertainty of the markets. For example, the ongoing severe drought in Panama has resulted in significant transit restrictions through the canal and greater travel around Cape Horn in the tip of South America. These conditions, combined with major armed conflicts, have resulted in an estimated 5% increase of ton-mile demand in 2024 for the dry bulk sector. Like many shipping sectors, the order book is a concern. Not so much this year, but a greater number of new build deliveries are scheduled for 2025 onwards. According to Drury, the order book is estimated to be approximately 20% for a total global fleet of 2,786 Kamsarmax and Ultramax carriers. This is a significant segment. That's a few things on the markets, both for tankers and for dry bulk.
Thank you very much. It's been very, very detailed, very clear. If I can just ask you, we had a start for the year. What is the current outlook for each sector?
Well, the outlook is positive for both product tankers and dry bulk. Our mid-sized eco vessels can transport a broad range of refined petroleum products and dry bulk commodities to a huge list of ports worldwide. The growth in cargo volume is expected to match net supply growth for the global fleet in 2024. However, as I mentioned, major geopolitical conflicts and weather related events have continued to disrupt trade flows, expand ton-mile activity while driving up charter rates and consuming available capacity. Consequently, we expect charter rates for both sectors to be constructive and ship values firm through at least 2024, but given recent events, volatility should be ever present.
Thank you. Eddie, I wanted to ask you, when you decided to diversify into the dry bulk sector, you made the decision to invest in Kamsarmax and Ultramax. So why did you pick those specific vessel classes within the dry bulk sector?
Yeah, I mean, first of all, let me say that our management team and board have extensive experience in the dry bulk shipping, and we were quite comfortable with the timing to strategically expand into the dry bulk sector by the acquisition of second-hand modern eco-efficient carriers. Last September, we closed on a JV to purchase a 2016 Ultramax dry bulk vessel, which is controlled by Pyxis through its 60% ownership position. And in mid-February 2024, we closed on the acquisition of a larger 2015-built Kamsarmax. Secondly, Kamsarmax and Ultramax carriers are as I mentioned earlier, are the mid-sized workhorse vessels which provide tremendous operational flexibility and diversity by cargo, customer, route, and port. So both of our bulkers are fitted with a ballast water treatment system and scrubber, which gives us a strong competitive position for employment at better charter rates while meeting all environmental regulations. Our dry bulkers have an average age of 8 years, which is 4 years younger than the industry average, and provide us many years of operational life. Importantly, As of February 29th, only 1 out of 6 vessels in the global fleet of Kamsarmax and Ultras are scrubber fitted, which underscores our competitive advantage.
And it is very interesting to repeat before I go into the next question that in both sectors, the product tanker and the dry bulk, you have strategically chosen to invest, of course, in eco-efficient vessels, but also in vessel types that are the workhorse of each particular sector. So it's worth pointing it out. Now, let's go ahead. You are in 2 sectors, dry bulk, product tankers. What are your expansion plans, and do you have a sector preference? And how do you plan to finance, if I can add to that, your growth? In your last results, you referenced your strong balance sheet and your robust liquidity. So if I can...
Sure. I mean, as I mentioned, we have strategically pursued diversification in the dry bulk sector, which has historically been counter-cyclical to the tanker space, and to some extent counter-seasonal. Our operating fleet now consists of 5 mid-sized eco vessels, 3 MRs and 2 bulkers. We have significant capital available and lender relationships to pursue further fleet expansion, always at reasonable prices. While we would love to acquire more modern MRs, prices have become extremely high on a historical basis due to positive sector fundamentals, geopolitical events, and aggressive bidding by well-funded operators. Even though we haven't found attractive product tanker targets, we chose to sell tonnage into a strong market last year and obtain very attractive sale prices for 14 and 8-year-old tankers, which generated over 25 million in capital gains. As to dry bulk, we expect to continue to concentrate on classes of modern mid-sized eco-efficient carriers, given positive market fundamentals, operational flexibility, and charterers' preferences.
Eddie, if I can now go to the next question. You referenced exactly, again, your strong balance sheet, your strong liquidity, but now looking at your capital allocation, how do you plan to balance it between funding growth on one hand and rewarding your shareholders on the other hand?
Well, as a small company in a cyclical, volatile industry where black swans have had a major impact over the last couple of years, it is paramount to maintain a strong balance sheet and utilize prudent risk management practices. One example is our diversified employment strategy by customer, which consists of short-term time charters to provide us a mix of predictable cash flows with the opportunity of spot exposure in a rising market. As mentioned, we seek to grow the company through selective fleet expansion using prudent long-term leverage. At the same time, we expect to continue our share buyback program. Since last summer, we have methodically spent just about 1.5 million to acquire 7.5% of our float. Currently, 10.5 million common shares are outstanding, with about 4.7 million shares in the public float.
And it is also worth mentioning that you are a major shareholder. So it's not only experienced management, but management with skin in the game, significant skin in the game. So going to the last question, since this is a podcast open to the public and to your shareholders or prospective investors, what is the investment thesis in Pyxis? What differentiates Pyxis as an investment alternative in today's market?
Well, the benefits of a diversified fleet of modern mid-sized eco vessels, which operate in 2 large sectors, which are driven by positive near-term supply and demand fundamentals, first of all. Secondly, strong financial position of good balance sheet liquidity and low leverage, which supports the effective allocation of capital for further growth plans in a disciplined manner. And thirdly, we put money where our mouths are, as you mentioned. Insiders have substantial ownership, which is totally aligned with our public shareholders. over 55% of common shares, and good governance standards. As a fourth point, I would mention that the attractive valuation by whatever metric you care to use. For example, at the year end 2023, shareholders' equity was 100 million, which is double our current market cap. Hopefully, more investors will appreciate the value proposition of Pyxis.
Eddie, thank you very much for this detailed and insightful discussion. I'm Nicolas Bornozis of Capital Link, and we had the opportunity to discuss with the chairman and CEO of Pyxis Tankers, Mr. Eddie Valentis, who provided us with an update on company strategy and also on the outlook of the two main sectors the company operates in, the dry bulk sector and the product tanker sector. So thank you to everybody for being with us, and Eddie, of course, thank you to you for this.
Thank you, Nicolas, for giving me the opportunity to address our shareholders.